Avenue Supermarts posted a better than anticipated Q1 result. Being the first normal quarter post-COVID-led disruptions, Q1 saw sales pick up in both old and newly added stores as indicated by the pre-quarter update. Also, both gross and EBITDA margin performance was ahead of estimates reaching pre-COVID levels seen in Q1 FY20. Among retailers, D-Mart is better placed as it derives close to 60% of its revenue from essential food segment, which has been relatively less affected by the current inflationary environment. And while the discretionary segment has been affected by inflation, D-Mart in its relatively older stores has seen positive volume growth, highlighting strength of its business model and everyday low cost, everyday low price strategy. While there are concerns about increasing competitive intensity in the grocery space led by online players, the share of organized segment is still in single digits, indicating huge runway for growth even for brick-and-mortar players like D-Mart. D-Mart is among quality stocks to be owned in the portfolio, and we tell you why. As indicated in the pre-quarter update, revenue in the June 22 quarter grew strongly, almost doubling on the low base of the corresponding quarter last year. Remember, sales in June 21 quarter were severely affected owing to restrictions in the second wave of COVID-19. So if we compare with near normal December 21 quarter, revenues were up 9%. D-Mart stated that June 21 quarter was the first full quarter of no COVID disruption. Robust sales growth in the June 22 quarter was also aided by reopening of schools and colleges and the onset of monsoon. Gross profit margins improved both YOY and QOQ basis. Gross margin improvement was owing to a better product mix. Improvement in EBITDA margin was on the back of benefits of operating leverage due to strong top-line growth. Net profit grew almost 6% on YOY basis and 50% on QOQ basis. Post the second wave of COVID-19, D-Mart resumed aggressive store expansion. In second half of FY22, D-Mart opened 32 new stores. The momentum continued in Q1 of FY23 with the company opening 10 new stores. Store openings were higher compared to pre-COVID levels. Remember, D-Mart had opened 8 new stores in Q1 of FY20. We expect the company to open about 120 new stores over the next 2 years. Since FY19, D-Mart has been opening bigger size stores. The store area addition has been to the tune of 25% CAGR compared to store number growth of 17% CAGR over FY19 to FY22. The trend of bigger size stores continued in Q1 FY23 as well. The new large stores are better designed and have the capacity to handle a larger revenue scale. D-Mart continued gradual expansion of the e-commerce business under D-Mart Ready. Initially, the company's focus is to cater to larger cities. D-Mart Ready is currently present in 12 cities. The company entered 7 new cities in the last fiscal itself. The current focus is to deepen the presence in existing cities. Also, D-Mart is running pilots of e-commerce operations in smaller towns and learning from customer feedback. D-Mart's scaling of e-commerce operations is gradual and measured as contribution in the overall revenue continues to remain in low single digits. While the essential food category seems to have done well, discretionary segments such as general merchandise, apparel, etc., their volumes have lagged owing to the overhang of COVID-19 disruptions and steep inflation. D-Mart stated that the share of discretionary categories in the overall mix is yet to reach pre-COVID levels. It said that with business conditions normalizing, apart from the old stores, the 110 new stores opened in the last 3 years also did well in Q1 FY23, implying pickup in demand. We expect D-Mart's earnings growth trajectory to accelerate in the current fiscal year as business conditions have also normalized. The stock is trading at a PE of 71 times FY24 projected earnings, which is lower than its medium-term historical average range, which was seen prior to COVID-19.